Hey entrepreneurs, I'm Dominique and welcome to The Domino Effect, where on this channel we talk about everything business, entrepreneurship, insurance, and financial literacy. And today we're talking about the top 10 reasons why your file is probably coming back as declined or you're getting an offer that's much lower than what you expected. So stay tuned, watch this video to the end, grab your free gift, and if you find this information valuable, then go ahead and share it with your friends, tag a friend, because the more this channel grows, the more I can continue to make more free courses and trainings just like this one. Now let's get into it. All right, now you all know this beast and it's bad credit. Now lenders, when they're typically looking at your application, banks, they typically want to see 700 and above. If you have a 680, 670 and you've got a good credit profile, you can typically probably get some type of offer. But again, that's dependent on your individual profile. Well, I want to dive a little bit deeper into credit because what we're talking about here is the profile essentially, right? So bad credit can be affected in a number of ways. We've had a client that had a 700, 730 credit score, but was declined by the lender because he didn't have age of accounts, had only recently just gotten a credit card like months prior, and they were in their 30s. So the lenders want to see that you have established history, that you know how to borrow, that you can handle this type of responsibility. If you don't have that type of proof of concept, essentially, then you're going to appear more risky than usual. Another thing about this is when you're applying online, we're in the digital age now. So there's a ton of new lenders that are online. You may know these applications, you click on them, you fill out 5 minutes, and then it spits out an approval or not. You need to be careful with these type of applications because sometimes they spit your application out to a bunch of lenders who will do hard inquiries. So if you don't know what's happening behind the scenes, then you don't know how deeply your credit can be affected. If you are applying for a loan and you're out car shopping, that can affect it as well. We had a client that had a great credit score, but had just gone car shopping and had acquired like over 10 inquiries. So these are the things that can affect your credit. Make sure you're keeping your inquiries to minimal, right? Under 4, and be simultaneously monitoring your credit. The second reason is you're actually expecting to get more than you can qualify for. Then what this means is, let's say you're generating revenue, and according to the revenue that you're generating, you should qualify for example, $100,000 in funding. You submit your application, you submit your bank statements, and you submit your financials. However, your offer is coming back way lower than expected. And the reason for that is, upon more further review, the underwriter can see that you have multiple loans that are current, right? So let's say you did something like MCAs, right? So you have multiple MCAs, which are merchant cash advances, which are short-term loans. If you have multiple of these, those are getting deducted from the amount of revenue you're generating. So if you cannot afford, what the lender is looking at is to see, can you afford to pay this money back? They're going to take into effect how much money you have going out. So if you have too much going out to other lenders, or if you have too many lenders and this new lender is coming in way below, then it's going to appear 10 times more risky. So be advised, be aware before you submit, and be realistic. If it comes back with a lower offer than you expected and you need this funding, then take it. You could also do something like getting the funding and then paying off those previous debts. That is another option for you. The third reason your application is probably getting declined or you're getting an offer lower than expected is you are doing something very unethical, and that is called stacking, meaning you have gone out and you have applied with multiple lenders and you've accepted the offer without actually sharing with the other lenders. This is very sneaky, you guys, and you're tiptoeing a very, very, very cautious line, okay? I highly advise you do not do this. Lenders do talk to each other on the back end, and when you don't disclose this information, I have seen where lenders actually pull back the funds. It's considered a type of fraud when you're not being honest, okay? So make sure you're telling the truth and you're not pulling one of these behind the scenes things. There's no problem with combining different lending products. You could do something like a line of credit combined with a term loan. You could do something like equipment financing combined with a line of credit. We see it happen all the time. But when you do something unethical and sneaky and you're not sharing it, then that is where you start to cross the line. Next one is time in business. Most banks want to see that you've been in business for longer than a year. And what about if you're a new business? What about if you're new, you don't have any real estate, you don't have any receivables, you might not have the best credit, because a lot of new businesses and entrepreneurs what do? We sacrifice our credit in the very beginning, right? So if you don't have cash flow, if you don't have credit, if you don't have collateral, and cash flow is coming from the business, right? If you're new, you may not have that yet. So what can you do in this situation? Well, there are non-depository lenders that you can look at. There's online lenders, alternative finance lenders that will lend to companies that are in business that are 12 months, 6 months, even 3 months. But under 3 months is going to be a challenge. No lender is going to lend to you if you've been in business for under 3 months. That does not completely knock you out of financing, because the biggest kept secret, and my favorite word, leverage, that is what business credit gives you. You can cross over and start building business credit, establishing your business credit to be able to access this under your EIN. That way you are not sacrificing your personal credit. Guys, you can get up to $50,000 within 6 months just by following a proven system, establishing your credibility and your foundation. Not to mention, as you grow, if you're going to be seeking SBA financing down the road, business credit is a requirement. And after all of the things that happened in the market, in the industry, in the news, banks are tightening up. They're getting a lot more restrictive. So you guys need to make sure that you give yourself the most leverage as possible. And that comes if you have minimal time in business. Even if you have a long time in business, you definitely want to be establishing your business credit. Now, if you have 6 months in business or 3 months in business and you have cash flow, well, then you can qualify for something called cash flow financing. But be advised, if you're generating something like $5,000 a month or $10,000 a month, you're probably going to get something around that or less, okay? And then also use it as a stepping stone to get where you're trying to go. With cash flow financing, there's a lot of different options out there. If you have receivables, you can do something like a line of credit or an inventory line of credit. So things like that. There are other options for you if you've been denied by the bank because of your time in business. The next reason is misinformation on the back end. What do we mean by this? Well, your business structure. I'll give you an example. We have business owners that buy out their partners. You have an amendment. Maybe you change your name. Maybe you change your business model. You change your structure. You've got new investment coming in, whatever that is. Maybe you change your bank. All these different reasons require an update. So if you are making any type of changes to your business structure, to your business name, you need to be updating it with your Secretary of State, IRS, with your bank. It needs to match across the board, you guys. I have seen it before where we have had instances where a client was not able to get the funding even though they qualified because they dissolved a partnership, changed the name of their business, dropped, I think it was one word or one letter in their business, dropped one letter in the business, and because they didn't update it with the business bank account, it was like starting all over. So you had to go into the bank, update it with business bank account, and then reflect 3 months of business deposits into that business bank account. So make sure that everything is matching. This will severely lower the amount you can get approved for if you're showing one address on one application, another address on the other, one phone number over here, your cell phone over there. It needs to be all credible. And if you want more information on how to set up a credible foundation, then just check out my other videos in the Start Here playlist, where we delve into how to set up a credible foundation. The next reason is if you have a partnership and one of your partners has poor credit history. Yes, this does come into effect. And I know we talked about credit in the beginning, but this is part of the profile. Let's say you're applying for something like SBA financing. SBA wants you to have a certain credit score. If you have a partner that doesn't meet the credit requirements, or if you have a partner that already got SBA funding and is not paying the bills, has defaulted on that, that could be a problem for you. So you might look into something like dissolving the partnership or finding out different ways of how you can resolve that. But this is where it comes back to your credit. Talk to your partners, figure out where you guys are at. As you're building, get with a credit repair person, get with somebody that can help you repair your credit. Another reason your application is getting declined or you're getting approved for less is maybe you're a seasonal business and you have inconsistent revenue. Inconsistencies breed chaos, right? Inconsistencies give lenders an uneasy feeling, okay? So, however, there are lenders out there that do understand seasonal businesses and they work very well with those businesses. You could look into lines of credit, you could look into factoring. There are many different options for seasonal companies out there. So you don't have to use your debit, you don't have to use your personal savings. You could use business credit as well to start getting your expenses under your EIN and not your social. One thing that lenders are going to be looking at, let's say you do have cash flow and you're applying for cash flow financing and you submit 3 months of business bank statements, 4 months if you're in California. If your statements that you submit June, July, August, September, June is $10,000 a month, July is $50,000 a month, August is $9,000 a month, and September is $60,000 a month. June, July, September, unfortunately, it doesn't matter because this one, August, was $9,000. So it's inconsistent, not to mention the $9,000 is under the $10,000 mark. So they want to see that you're hitting that mark every single month, whatever that tier is that you're at or what you're applying for. But that's okay, all right? There are other options out there, so make sure you're scheduling your one-on-one with one of our advisors so you can see exactly where you stand and what you qualify for. And that last thing is if you're consistently up and down like a roller coaster, your financials are out of order, your paperwork is out of whack, you don't have any type of business plan put together, then this is going to delay your application for funding, especially if you're stepping outside of traditional bank funding. It's good to be prepared. This is how you can get ahead of it. Get with an advisor. You can connect with organizations like Small Business Development Center, Minority Business Development Center, Women's Business Development Center, your local CDFIs, and you can connect with DFX, which is a funding platform, our funding platform as well. But the best thing that you can do is know where you are. So schedule your free funding blueprint. And so you can figure out what you qualify for. And if you don't qualify for, what the steps are to get you there. Because the worst thing that you could do is continue to beat your head against the wall, is continue to use your personal credit, is continue to over leverage your personal credit so that you can't do anything in your business, right? The worst thing that you could do is just not make any moves in the right direction. So you've already started by coming to the right place and coming to this channel. So if you found this information valuable, please do me a favor and subscribe, hit that like button, and go ahead and send your questions to 888-488-4145. This is how you're going to increase your approvals in 2025. Start establishing your business credit, stay prepared with your financials, meaning get with a CPA, get with a tax strategist, learn how to put together your documents, get with resources like QuickBooks that can help you if you're just starting, and then also download your free funding guide at the end of this video. That's it for today, guys. I'll see you next time. Bye-bye.